Well, thank you everyone for being on tonight's call. We're so delighted to have a really good friend of Protect Wealth, Kwame Granderson, a really sharp attorney out of the Los Angeles area. We're delighted to have him. He's been a friend of us for a very long time, and one of the very, very few people in this industry that I just absolutely have all the respect in the world for and trust him emphatically. So we're delighted to have him. Let me go through a couple little housekeeping things first so that you kind of know where we're at. If this is your first time here, and it looks like a lot of people I haven't seen before, this is a long-term asset protection webinar series that's been going on for almost a decade now, maybe over a decade. And just the last few months, we've had Scott Estwell, a former senior trial attorney from the IRS, on, a CPA and tax attorney, John Anderson. We've talked about cost segregation. We've talked about evaluating real estate markets. We've talked about anonymity in your business, creating tax-free business from a CEO of an IRA custodial group. And in the next couple of weeks, we've got how to protect intellectual property, copyrights, trademarks, trade secrets. It's such an important part of most businesses that we don't really consider. We considered real estate and stocks and cash, but we don't really look at protecting intellectual property. I'm looking forward to that. How to profit from a nonprofit corporation, selecting the best tax structures for your business. There's a lot of things coming up, so pay attention to your emails. And if you need to, go to our website, protectwealth.com. All of the recordings that we do are on YouTube. And so we encourage all of our students to go to the YouTube channel. Just click in YouTube and go to type in Protect Wealth Academy and simply subscribe, and then you'll have access to a whole plethora of probably close to 200 hours of webinars that we've recorded over the years, and some really good recordings of some of our summits. We encourage you to do that. There's so much information out there. And if you subscribe, then you have access to everything. We just finished last week a live event in Orlando. It was our very first live event in, I don't know, 20 months, a year and a half, whatever. It was really good to see people face to face again. And we had some great students, new students had never been with us before, and some old timers that have been with us a long time. But wow, what a remarkable event. But we've got a live stream event coming up in 3 weeks from yesterday. If you didn't get a chance to go to Orlando, or a live event in Las Vegas, that both of those classes we're currently taking registration for, go to protectwealth.com. But the live event in Las Vegas, the room block will be open for another 3 weeks. We've got a very, very nice room rate for Vegas this time of year. I think it should be a really good room rate, but it's a beautiful property. We've been going to that same resort for close to 15, maybe 18 years. We've always hit the second Monday, Tuesday, Wednesday of November. And with the exception of last year with COVID, an absolutely beautiful property. And they treat our students very well, so we keep going back to that. So whether you do the live stream event or the live event in Las Vegas, the core content will be pretty much the same, although there's a lot of changes with tax law, with pending tax proposals. There's a lot that we constantly update every time we do a summit. If you're interested in the agenda, that's available on our website. we generally post the real one. Here's exactly what we're going to do. But there's a really good sample that doesn't change a whole bunch from time to time to time. The live stream events tend to be shorter, but the live events, you get a chance to meet with the attorneys, with the speakers one-on-one. And so whatever meets, we understand not everyone is willing to travel right now for good reasons. We get that. But if you are, we would much prefer to see you in person. All right. And last of all, before we turn time over to Kwame, there is always a legal and tax disclosure. What we talk about on we can't give specific legal, tax, investment advice. We can teach general principles. How those principles apply to you in your situation is really for a tax professional. Or a real estate investor or an investment advisor. We're simply here to teach good, strong principles. And with that, let's talk about what we're here to talk about tonight. It's been almost 10 years ago. I think it was around 2012 or 13. I got to attend a class that Kwame was teaching. It was how to raise capital. And of all the classes, I went there as the vice president of legal and compliance, and to make sure that everything. I've never been so impressed with a speaker, with their integrity, with just the. Sometimes we in this industry, you get a lot of paid people that get up and give a great speech, but somebody that was really in the industry, who's raised millions and millions and maybe hundreds of millions of dollars in venture capital. He knew what he was talking about, and he talked from experience. And he's very quiet. He's very unassuming. He's a very humble man, but the wealth of wisdom that Kwame has, I don't know anybody that can teach what makes a good investment better than Kwame. And so this is really what we ask him to speak on, is with all those people that he speaks to, the questions that they ask and the questions we should ask about what makes a good investment. How do we strategically plan our investments so that they grow? How do we look at the market and what should we be asking every time we put our money down? Kwame, we're so excited to have you here. Kendall and I will both be in the background if you need anything to answer questions. And how do you want to just kind of present and then we'll answer questions later? Or do you want us to interrupt you with questions, or what's best for you?
Yeah, if you don't mind, I'd like to go through the presentation and then I'll take questions at the end.
Okay, so let's do that. So when you have questions, if you will put them into the Q&A screen, not the chat screen, but the question answered screen, and then we will get to those. But my guess is, knowing Kwame a little bit, he's got a very logical, sequential presentation that I think will be designed to answer most of the questions before you even get to them. So Kwame, thank you for being on. We're so excited for your presentation, and we'll turn time over to you.
Thanks, Don. I appreciate that. So let's just go ahead and jump right in. What I want to talk about is initially why you should even invest, what's the point, and then what, if you're going to do it, then what do certain investment structures look like, right? And then what are some of the due diligence questions you should ask? What are the kind of top 10 things you want to know? And then sort of what happens next once you decide that this makes sense? What are the steps that you typically go through to actually execute on that? So let's just begin with this idea of why should we even be investing in general, right? So about a few years back, about 5 years ago, I was talking to a friend of mine about Boise, Idaho. And this person was asking me, well, should I invest? If so, why, where, what are some of your thoughts? And I said, well, I'm kind of at a different level now, but if I were starting out and I was looking for a place to go, I said I would get on a plane and go to Boise, Idaho. And I said, the reason is because it's got, I believe at this point, the fastest growing population of any state in the union. And if you read articles where the construction industry is being interviewed in Idaho, they repeatedly say that they are not building enough to keep up with the growing population. And normally that equals higher than normal rates of appreciation, right? Because you have not enough supply and a lot of demand, right? So let's just assume you inherited $50,000 5 years ago, and you were thinking about buying in Boise, Idaho. You could have gotten a house for about $210,000. That house today is about $350,000, right? So part of the question as to why do people who have resources, why do they invest? And the answer is because in 2016, if you had to put 20% down on this house of $210,000, you would have put down a down payment of $42,000. If you went to buy that same house today, you'd have to come up with $70,000. So in order to achieve the same lifestyle, if you were going to live in the house, or the same investment objective, you would have had to put up more money than you had to work with, right? So in 5 years ago, your $50,000 would have gotten you in the game. Today, your $50,000 doesn't get you in the game, right? I refer to that as erosion, right? And I refer to it as erosion because I think of it as a different phenomena than normal inflation. So normal inflation, let's call it on average historically 3%. Normally when people talk about inflation, what they're talking about is consumer goods. They're talking about the price of cars, the price of bread, the price of the TV or something, right? That's the kind of inflation, the price of a latte, right? That's the kind of gradual creep of cost that they are referring to when they talk about inflation. But this example that you're seeing on the screen right now is a little bit different. It is because real estate tends to be yes.
Sorry to interrupt you. You don't got to hit share screen again. I'm sorry on this end. It's still showing Dawn's screen right now, it looks like.
Oh, okay. Well, then let me go back and.
My apologies.
Sure. Let me get out of. So I have to unshare, or do I
just hit share screen, the green on the bottom. So where you see the main Zoom screen, hit the green share screen button, and it'll make you actually reshare again. Yeah.
Yeah. Hold on. I got to come out of it, and then I got to go back into it. Hold on a second.
Yeah, that's the only thing with Zoom webinars. It kind of does that to us a little bit, but thank you. I can't do it for you.
Yeah, no worries. Just let me know if it's working now.
Why invest? There we go. Yep, and just go ahead and hit play, and let's make sure that works okay for you.
Okay, so
that's good. It's great.
So you see it now?
That's great.
All right. So so I was talking about erosion, and I was talking about this idea of when you have a certain amount of capital to work with, if you don't deploy it in a strategic way, and that's why I called this presentation strategic investing, is if you don't deploy it in a strategic way, then it essentially gets eroded in terms of the kinds of opportunities you can pursue. So had someone, this person I was speaking to, I don't believe they took my advice at the time. I wish they had, but if they had, right, their 42,000 would have generated another 140,000, right? Now, the good news is that's happening all over all the time. So it's not as if that person can't get into some other opportunity. It just means that in this particular market, if for some reason they suddenly became fixated on Boise, Idaho, that opportunity would have been eroded, right? So let me give you a way to think about how to identify situations where you can benefit from / prevent being eroded by, right? So I call this heat path investing. So this is a map of call it Los Angeles metropolitan area, like Southern California, basically. And so you've got Santa Monica, which is kind of a coastal beach area to the left, and you've got, Culver City and some other areas that are in Southern California. So the 2 million, the red equals 2 million or more in terms of the price of the property. Yellow is $1 million to 2 million. Light green is 750 to 1 million. Dark green is 500,000 to 750, right? So the reason I like heat maps like this is because in a kind of a snapshot with a very quick visual, you can kind of see exactly where the heat is moving, like the direction is moving, what's gonna heat up next. And it takes a lot of the guesswork out of it, in my mind, because it's sort of difficult for this much data to be wrong, right? Each one of these little tiny dots, if I were to mouse over it, it's an actual house with an address and a person's name on title and so on, right? So this heat path is moving in the direction of a city called Inglewood. Now, when I was growing up, Inglewood was not that far from where I lived, and it was not the properties were not very expensive in Inglewood. But as you can see from this map, at the very tip of where I've kind of got the border outlined, you see the yellow. It's kind of going yellow, light green. So it's bleeding into this Inglewood area, right? So what ends up happening? What causes this kind of movement is, for example, in Inglewood, they just built SoFi Stadium where the Rams and the Chargers played football. It's a stunningly beautiful stadium, and more importantly, around the stadium is blocks and blocks and blocks of new development, hotels, bars, restaurants. The entire area is being developed in a way that's going to have a massive impact on value. In addition, they just spent a massive amount of money in the city building what was called this light rail K line that's going to connect LAX to Inglewood to an area called Crenshaw, which is also an area that previously property was pretty expensive. And then in addition to that, in 2028, you're going to have the Olympics in LA, which always triggers a lot of development, right? So these major infusions of capital into these areas is triggering this heat path. So when you see that, you don't have to guess at what's going to happen. It's pretty clear what's about. You don't have to be some real estate genius. You don't have to be, have a crystal ball. It's pretty obvious what's about to happen. And it's going to happen in the not too distant future, probably, right? So what happens when you don't react? So you see a heat path like that and you don't react to it. Well, this is what tends to happen, right? So all this red 10 years ago wasn't all red and it wasn't all yellow, right? There was a lot of green, and in fact, there was a lot of dark green, especially in some of these Hollywood areas. Certainly when I was growing up in LA. Right now, this area, if you didn't already buy in this area, you would have experienced this kind of erosion that I'm talking about, where that fixed amount of capital has less of ability to get you in this particular game, right? Because this game is a red game now, and so you have to have more resources to get in, right? So when you see this kind of path, the question is, how do you react to it? So let me tell you, I'll give you an example of what I did. If you look at where in Inglewood, where the kind of light green meets the dark green, you'll see that I bought a house that was right there. This is the house, this is the actual house, right? And I bought the house for a very specific reason, because in addition to heat path investing, there's also something that I call disequilibrium investing. And what that means is it's investing in something that's out of whack for some reason. There's something that's wrong with the market, and it causes this opportunity that tends to be a window of time. that you during which you have to take advantage of the opportunity. So in this case, California has an incredibly acute housing crisis right now. And so as a result of that, you've got homeless people, tens of thousands of homeless people in a state that's one of the wealthiest. Well, its economy is so large that it's, if it were a country, it'd be in the top 10 economies in the world, right? California has a massive economy, and yet it's got homeless people on the street. So if you're a politician, how do you react to that, right? You're trying to win re-election, and you've got homeless people sleeping on the street in areas where houses are selling for $1 million, right? That is out of whack. So what do you do? What you do is you pass a law that says, hey, not only can owner occupants, but investors can take their properties and they can convert the garage, they can build a freestanding additional unit, they can build a tiny house in the backyard, they can do things without complying with the normal ordinances like parking requirements in order to create additional housing. Now, here's what you don't see every day, okay? Now, this is an actual quote from California Department of Housing and Community Development. This is a quote from the book. The rent generated from the ADU can pay for the entire project in a matter of years. Now, when is the last time you've seen a document issued by a state telling essentially the investment community that we are allowing you to do something that is so profitable that it will pay for itself in a matter of a few years? And to be more precise, it's about 3 years, right? The cost of the revenue generated by this additional unit basically pays for the cost in about 2 to 3 years, right? Completely. And from that point forward is just free cash flow. And they're basically saying, we acknowledge that we're creating this economic windfall. And because we acknowledge that, we are going to only give you guys until January 1, 2025 in order to capitalize on this. So in other words, build as many of these things as you can, convert as many of these things as you can. We're going to allow you to make as much money as you want to until 2025. And then we're going to shut it down because hopefully we would have made a big enough dent on this problem by then to have addressed the issue, right? So this is an example of a profit opportunity that is not related to necessarily the economics of what it costs to buy this house, right? So the person selling this house thinks they're selling a single family house, but what they actually sold to me was a duplex, right? Because of this little statute that says I can take that garage in the back, I can convert it into a separate unit with its own street address, its own plumbing, its own electrical, rent it out separately, add no additional parking, dramatically increase the value of the property, create significantly more cash flow for very low expenditure. And the state is saying, not only is that okay, but we're encouraging as many people to do that as possible. So, so I'm going to give you another example of where I saw this same sort of disequilibrium and it had sort of the same effect, right? 2014, I'm looking at across the US and I'm looking at sort of I did a lot of research on affordable housing and the fact that 10% of Americans live in mobile home parks, except that there was this weird anomaly, and this is the only asset class I can think of that has this weird anomaly. Most municipalities, their zoning ordinances did not allow for any additional mobile home parks to be built. Okay, well, that's unusual. There really, there aren't too many ordinances that say you can't build more office buildings or you can't build more multifamily apartment complexes, right? But a lot of cities, because of the stigma associated with mobile home parks, had ordinances prohibiting further mobile home park development at a time where there's a severe affordable housing crisis because baby boomers were retiring and needed housing. So you have this kind of bad math being driven by prejudices and assumptions about what mobile home park living is, that is not economically driven, it's stigma driven, right? So if you look at the business plan I wrote back in 2014, it said, dear investor community, we need to buy as many of these parks as we possibly can before somebody figures out that this is bad math. This doesn't make sense, right? These parks should be more, they should cost more because they're so valuable. So the result is, you know, when there's bad math like this, you have an asset that's poised for higher than normal appreciation, and that's what happened. So during that time, you know, I sort of ran out there and bought as many of these things as I could get my hands on, starting in about 2014 to the present, right? And as a result of that effort, I ended up acquiring 28 communities with 4,300 sites and about $200 million of value. But here's the important point. The important point is this. One of the ways to combat not only erosion, but this idea of general inflation or creating a hedge against the general rise of the cost of things is when you start amassing a cash flowing portfolio, especially in an environment where the properties weren't priced properly in the first place. Here's what happens. In this portfolio right now, I just did this math today just because I was curious, because I knew I was doing this presentation, I was curious. In this portfolio, every time I raise the rent $10, it creates approximately $9 million of value. So, you know, if I just do an across the, and every year we do an across the board $10 rental increase. And so every time we do that, it creates about $9 million of value. And it's because these parks have now gone from being stigmatized to being so desirable and so valuable that every time you create a little bit of extra income, the value of the park goes up incredibly. So now the money that is in these parks is now sort of working for you, right? And so instead of rising rents and rising prices working against you, which is the situation that many of us find ourselves in, where, you know, oh my gosh, rents keep going up and prices keep going up and I'm getting priced out of this market, or I'm getting priced out of the rental market. When you put yourself in a position like this, now those rising rental rates actually benefit you every time they go up, right? And so that's one of the reasons that wealthy people invest, is so that this rising tide actually benefits them instead of locking them out of the market. Okay. So how do you put your money to work? Like, what do these investment structures look like? How do you get involved in them, right? So so I want to just go through, and obviously this is this is a high level overview because we only have an hour. So I want to just give you an overall sense of what this looks like. It's not exhaustive by any means, but one way to approach getting in the game, let's say, is kind of a true sort of joint venture partnership. Two people get together and they say, let's do this together. They're both investors. They're both managers, right? You put up 50,000, I'm going to put up 50,000. I'm going to put up 100,000. We're going to put it into Make It Happen LLC, and we're going to make something happen, right? The problem I found doing this for many, many years is when you use this kind of structure, you end up with too many cooks in the kitchen. And so you end up with a situation where, well, you know, I really, really think, you know, we should use that flat white paint on the ceiling because that really looks classy and subtle. No. I you know, really the ceiling needs a pop. I think we should go with, you know, fuchsia because, you know, a lot of people are into fuchsia these days, right? And so you're every little decision potentially becomes a point of contention. And it's just hard to get things done, right? Especially in an environment where a lot of decisions have to get made. And the more that's riding on that decision, the more contentious it tends to get. So the other structure, and the more common structure, is there's an investor member who puts up most of the money, and then there's a manager member who puts up little or no money. And the investor member they're getting a stake because they're putting up money, and the manager member is getting a stake because they're doing most of the work, otherwise known as sweat equity, right? So this is the more common structure. And the question is, so how do you split profit in this kind of a situation? And what factors determine that, right? So the main factors are sort of three. One is, how knowledgeable is the manager? How much, in addition to just being willing to work hard, how much knowledge is the manager bringing to the table? Two, how proprietary is the deal? So is this a deal that anybody could have done, or is there something special about this deal? And three, how much is the manager protecting you in this structure, right? So how knowledgeable is the manager? So is this a deal that requires environmental compliance or cleanup? Is there some sort of tax advantage to this deal, right? Where, 1031 exchange, opportunity zones, right? These are strategies that require specialized knowledge. Is this a ground up development? That requires a lot of specialized knowledge, right? So the more specialized the knowledge, the more likely you are to achieve significant returns, because knowledge creates barriers to entry, right? So if the managing member is bringing a lot of knowledge to the table, then the passive investor, the person putting up most of the money, is going to benefit from that knowledge, and that's going to affect the split that managing member is entitled to ask for, right? Same thing with the proprietariness of the deal, right? Is this a deal that requires some sort of special relationship, or is off market and somehow this person has access to it? Or is there something about how this deal came to the table that would be difficult to replicate without this particular person, right? There's value in that, right? Because if it's more proprietary, there's less likely to be a bidding war where value gets eaten up because somebody else knows about it and they're bidding the value out of the deal, right? And so that managing member bringing that kind of deal to the table has value, right? And then finally, to what extent is the managing member protecting you? Meaning, is this a deal where you're going to have recourse liability on the loan? So for example, if you're going to buy a property and Bank X is going to do the loan, is Bank X going to require the managing member and the investor member to be fully liable if this loan defaults? Are they only going to require the managing member to be liable, right? If you're protected as the investor member from liability, you don't have to be on a loan. There's no recourse to you. There's value in that protection, right? Because the less exposure you have, the lower return the passive investor is entitled to ask for, right? So if you think about it this way, if you're totally 100% protected, it's a municipal bond and it's guaranteed X return, that return is going to be low. It might be 1 or 2% because you essentially have no risk. The higher the risk and the more exposure you have, the higher return the investor member is entitled to demand. And part of that risk equation is the extent to which you're exposed to recourse liability. And then, how are the losses allocated? Are they allocated to investor? Are they allocated to manager? Are they split 50-50? These are things that you want to know because it's going to affect. And when I say losses, let me be clear about what I mean by that. Because a lot of people think when I say losses in this context, I'm talking about like tax losses, like who gets to write off what. I'm not talking about that. What I'm talking about is $100,000 goes into a deal and the deal doesn't go the way everybody planned and only 95,000 comes back out. Is that $5,000 loss split 95.5? Or does a managing member take that full $5,000 hit first before the $95,000 gets impacted, right? That's what I mean. To what extent is that kind of protection afforded? So when I was, in my 20s and 30s and getting started with these very simple structures, all my deals were structured that way. They were structured in the way that to the extent that I had money in the deal, I would take that first $5,000 loss or whatever first, right? Because I didn't have quite as much experience. I didn't have quite as much infrastructure. I didn't have I wasn't taking on as much recourse liability, et cetera, et cetera, et cetera, right? As funds get bigger, as deals get bigger, you allocate the losses differently. And what you do is, as the managing member, you take on more recourse liability. So you end up taking on tens of millions of dollars of liability in order to protect your investors from any sort of exposure, right? That ends up being the trade-off. And all of these things, knowledge, degree of propriety, protection, all of these things feed into what's called the waterfall. And the waterfall is essentially, how does the profit get split? So let me give you an example. There's a $500,000 investment and it makes $150,000 of profit. So here's a really simple, basic waterfall. You take that $150,000 profit, 8% goes to the investor first, before anybody else gets any profit. 8% goes to the investor. So 8% of $500,000 is $40,000, and so $40,000 is now off the table, right? So that leaves $110,000 of profit, and then that gets split, let's say 50-50. So then what ends up happening is you end up having a waterfall where the person who put in the sweat equity, the manager, that person gets 55,000. And the person who put up the capital, the 95,000, that person gets, the $500,000 in this case, that person gets $95,000 of profit on their $500,000 investment, which is a 19% return on their investment, right? So the investor member gets a very healthy return, 19%. The manager gets $55,000 for their time and effort. Everybody wins, right? Just as a point of reference, any investment that yields sort of north of 8%, certainly any investment that's in the double digits in this market is a very solid return. If you can get north of 15%, you're in absolute home run territory as a passive investor, right? So in this example, everybody did well. Now, obviously, every time you have a $500,000 investment doesn't necessarily mean that there's $150,000 of profit, but what you care about is what does the waterfall look like and who gets paid in what order, right? That's what you want to be asking about if you're thinking about investing in something. So the other sort of example I kind of hinted at a few minutes ago, which is the fund structure. So the fund structure normally it's a bigger investment, more investors, more capital at risk because you're buying bigger assets, and therefore the managing member is taking on more responsibility and more liability because of the amount of recourse liability they end up assuming. So in this case, it's, you have 4 investors, everybody's putting up $125,000 into Make It Happen Fund, LLC. And that $500,000 is going to be used to go out and do something, right? Buy a property or buy a couple properties. And here's what you care about when you're considering a fund. The question is, most funds require you to be accredited. So because what they're trying to figure out is, because there's so many investors, they want to make sure everybody involved is a sophisticated investor. And the government has said, if the person meets this requirement, we're going to assume, we don't know the person, but we're going to assume they're sophisticated. And that requirement is that there's a net worth of $1 million, not including your primary residence, cash, stocks. You have investment property that has $1 million of equity. You have either $1 million of net worth, not including your primary residence, or in each of the last 2 years, you made $200,000 as an individual or $300,000 as a couple. If you meet that, if you satisfy those requirements, you're accredited. And normally there's some sort of process that you have to go through to make sure that you meet those requirements. Okay? It's a very simple process. It's you fill out a form and they do a couple checks and it takes a day and it comes back and they say you're accredited and you're good to go. All right. So the other types of things that you want to be thinking about when you're looking at potential investments is, does this investment opportunity accept self-directed IRAs? And if so, you want to make sure that you're going to be able to get annual valuation statements on the value of your investment, because normally you're going to need that for your records on an annual basis. Okay. If you're doing a 1031 exchange, and I'm not going to go into in this session what a 1031 exchange is, that's for another time. But for those of you who might be in this situation where you might be selling an investment property and you need a replacement property to satisfy a 1031 exchange, you want to know if this particular opportunity will accommodate that. Why? Because if you're doing a 1031 exchange, the money cannot hit your personal account. So when you sell that first property, the money has to go to a neutral intermediary, and then from that person to the investment. And so you just want to make sure that A, they can accommodate that, and B, that they know how to flow the money properly so that you don't have tax implications. So then the question is, so how does debt fit into this? So one person puts up 95, the other person puts up 5, you get 100,000, a lender puts up 400,000, and you buy a $500,000 property. What does that look like in terms of the role of lenders? Well, there are two types of lenders you want to be potentially considering for these kinds of ventures. The most likely lender, if you're going to be in a venture that's doing deals where there's significant work, let's say you're buying a house and there's significant work to be done to the house. Hard money lenders don't have FICO score requirements, but more importantly, they will lend on properties that are structurally damaged, fire damaged, or need significant work, and they fund quickly. So you find a deal and there are a couple other people bidding on the deal, and you want to be able to say, I will close in 15 days. That other person needs 60 days or 45 days to close. I will close in 15 days. A hard money lender will close in 15 days, right? So for a lot, pretty much all of the deals I did when I was getting started, not pretty much, 100% of the deals I did when I was getting started, I did with hard money lenders because they funded quickly and they were all flips. And traditional lenders would not fund on the kind of properties I was buying because they needed to be gutted, right? The disadvantage is they have high interest rate, higher fees, shorter term. So what you have to weigh is, do I care if the interest rate is 10% if the alternative is I don't get the deal at all, right? So so you have to look at that and decide whether that deal pencils out based on that interest rate, because, as I said, the alternative might be that you just aren't able to close on the deal. The role of traditional lenders is they can do bigger transactions. They can do long-term transactions. Hard money lenders tend to be short-term transactions. They can do construction loans. They can do a lot of they can do credit facilities that allow you to do, capital expenditures on bigger assets. The disadvantages is they tend to be slow. They tend to be very conservative in terms of how they underwrite the deal. And they tend to be very selective. Like we're working with a bank right now that the minimum loan size is 5 million. They just will not consider a deal if the loan is less than 5 million, right? Well, you might have a deal that's $3 million. It's a great deal, and it checks all the other boxes. But this bank is not going to do that deal because they're very selective about the size of the deal they want to be involved in, right? So the role of the lender in putting this overall venture together is going to end up being important, and you should always, 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 always have a strong banking relationship as part of any venture. That's critical, because a strong banking relationship can solve many problems that you might not anticipate until the problem arises. And if you have that relationship, you can sometimes solve a problem that otherwise would become a real serious issue. Okay. So let's now talk about some of the due diligence that you might want to do, and I want to structure this as sort of the top 10 questions to ask after the sizzle. So after you get the glossy presentation and you get, the rah-rah about how much money this investment's going to make, and because everybody's going to want to give you that, right? They're going to want you to focus on how well it's going to do. I just had a meeting with my team earlier today because I'm working on a condo tower that is going to be 100 condos roughly and a restaurant mixed use development on the beach in Mexico. And so I'm meeting with my team today, and we're talking about this condo tower. And one of the team members, her job, she's an economist, and her job is to work with me in building the economic model for this particular deal. And I think it's going to be a fabulous deal. But what I said to her was, I said, your job is to figure out what it's going to take for me to break even on this transaction. Meaning, do I have to sell 60 condos, 50, 62 condos? How many condos is it going to take based on what we know about the market for this deal to break even? Why? Because when I go into any investment, all I want to know is, how do I not lose the money of the people involved? Everything that, if it makes money, fantastic. And if it's a home run, even better. But my first and most important priority is, how do I not lose money? Because there's no such thing as a deal that exactly breaks even. So if I don't lose money, I'm probably going to make money. So my focus is, where's my break-even point? And then I make sure that, with belts and suspenders, that we can hit that break-even point. And if that's 62 condos, and that's what I care about, right? So you want to get past the sizzle, and you want to figure out, question one, what could go wrong? Like, okay, you told me what could go right. Talk to me about what could go wrong with this investment. How long will my money be tied up? Right? Is this a year? Is this 6 months? Are you going to give it back to me in 5 years? I've seen investments where you're locked up for 7 years. And I've seen investments where people didn't realize they were going to be locked up for 7 years, right? You want to know. And you want to know, how do I get my money back? What's the exit, right? So are you going to sell? Are you going to refinance? Are you going to just write me a check and buy me out? Like, how do I get out of this thing, right? Sounds great. I want to get in, but how do I get out? How do I keep track of my investment? So question number 4 would be, what kind of financial reporting should I expect? And, there is no right answer to this. There's all different kinds of financial reporting. Sometimes it's every month, sometimes it's quarter, sometimes it's normally more frequently than once a year, but the important thing is to understand, what is the expectation around financial reporting, and roughly when can I expect it, and what's it going to look like, right? Who will be my point of contact? That sounds like a really basic thing, but trust me, if something starts to go wrong with that investment, you want to know who you're going to be able to reach, right? I've had people come to me in my capacity as a lawyer. I've had people, I don't really practice as a lawyer, but I've had people, just friends, say, you know what, I invested in this thing and I can't reach anybody. I don't know how to get anybody on the phone, right? And this last report I got was pretty troubling, and I'm calling this number and I can't get anyone. I'm calling that number, right? You really want to know, who do I contact? Am I going to have ordinary income or capital gains, right? What tax rate can I expect from this? Will I get depreciation benefits on top of, the return on investment? Will there be other kinds of tax benefits I might expect, right? And then these last three, to me, are sort of the most important. What is your track record? Is this your first rodeo? Have you done this before? Do you have a track record in doing successful investments? If you've done other kinds of projects, have you done, what types of deals have you been in? Has it been all multifamily and now you're doing an office building, or has it been all, self-storage and now you're doing a hotel? Like what have you done? And this question, I cannot tell you how important this is. I literally had I get presented with a lot of deals. A lot of people ask me to go into their deals. People come to me to go into my deals, and also people come to me to ask me to go into their deals. And I was sitting in a with a guy a couple of weeks ago, and he's going through all the sizzle. And he gets done with the sizzle, and I say, great. And so I start walking. I started with question number 9. I said, let's just start with, you keep saying we, you keep saying us. Who's we? Tell me who we is. True story about 2 weeks ago. I had to ask that question 4 times to get this person to tell me who we was. Who are you talking about? And it became clear to me that the we wasn't really well defined yet. They hadn't quite figured out who was going to be involved in this thing, and who was going to be driving the bus, and who was going to be sitting on what seat on the bus. And I was thinking, just so you know, if you have to ask this question twice, you're done with that meeting. That meeting's over. From my perspective, if I can't get a straight answer from you the first time I ask you who's on your team, and you can't say this person, and this person, and this person, and this person's going to do this, and this person's going to do that, and I'm going to do this, that answer needs to be crystal clear. And if there's any uncertainty floating around that answer, all kinds of red flags should be going up, right? Incredibly important question. Seems basic, very important. The last question actually came from someone who is on this webinar tonight, I believe, according to Don. Don told me he's on the webinar tonight. And he asked me this question: would you put your mother in this investment? And I thought, you know what? That is an awesome question. I'm going to add that to my presentations from now on, because what it does is, even though it's not a literal question, the person doesn't literally mean, are you putting your money in? It gets a visceral reaction from you. Because if there's something shady about your deal and someone hits you with this question, it's going to be hard to hide that. Now, it turns out, in my case, my mother is a part of my company. My mother and my father are in my company. So I'm very comfortable with this question. And my mother is heavily vested in a lot of what I do, because I'm very confident in what I do. But the question itself, I think, is so viscerally powerful that it would, if even if someone were a pretty good poker player, their tell would be triggered by this question. And so I added it to this list because I just think it's a wonderful way to look someone in the eye and just see if they are coming from a genuine and sincere place. So let me just quickly go through next steps, and then because I know that we're getting a little bit short on time here, but so you've gone through all your due diligence, you're comfortable with the structure, and so what happens next? Well, you did, if the person says they're a lawyer, look them up, see if they're a lawyer. If the person says they're a real estate broker, look them up, see if they're a broker, right? You go through your accreditation. Then normally you're going to do some sort of document signing, meaning that if there's a joint venture agreement, you're going to be signing a joint venture agreement. If it's a fund, you're going to have something called a subscription agreement. And so there's going to be some sort of document that memorializes this arrangement that you're entering into. It's something you probably want to have a lawyer look at. If someone is uncomfortable having, you allowing you to have a lawyer look at this documentation, that is a massive red flag. There should be no reason you can't have a lawyer look at these documents. If you choose, right? The other step 4 is normally some sort of mechanism for how are you going to get, if there's a monthly distribution, for example, how are you going to get that? Check, ACH deposit, like what does that look like? Seems like a pretty administrative thing, but you want to know, like, how am I going to get my money every month, right? What's it going to look like? And then where do I wire, right? So, and then you wire and you're off and running, right? So that's normally the process that you go through. And that, has taken me right to 6:30. And so with that, I just want to say thank you. Don, I'm sure that you've probably got some questions that you want me to address, but that's the end of the official presentation.
Well, thank you. So let me throw out. So students, if you've got questions, please type them in right now. Kwame, how many investors, how many different investments over the years have you been in? Hundreds? I mean, you started out at Harvard Law School, you came out and you immediately wanted to go into investing, or how you got started with this?
Yeah, well, so, I mean, my first year out of law school is 1996. From 96 to 97, I flipped 12 houses in exactly the kind of structure I just described. I had, a passive investor, I was a managing member, and I flipped 12 houses. So that was my first year. So yeah, I have to say hundreds. I've never, honestly, Don, I've never really stopped to count how many deals I've done at this point, but I've been doing this for, 25 years. And so, yeah, I've done a lot of deals and I've seen a lot of structures. And, in my funds, I have over 100 investors just in, my mobile home park funds now, right? So I've dealt with every kind of investor you can think of, from Fortune 500 executives to, Grandma Smith, who's got $100,000 she wants to do something with right now. One of the things I'd like to share with people is, generally speaking, I do not allow people to invest more than 50% of their total liquidity. So if the minimum investment is $100,000, I generally like to see people have at least $200,000 in their bank. If somebody has $100,000 and the person says, yeah, put all $100,000 into my whatever, that should be a red flag, because that's going to put that person in a position where they're pretty strapped.
One of the things you taught me a long time ago, that unless the manager has money in the deal, stay out of it. And I think you have money in every one of the deals you do, don't you? Why is that so important?
It's important. It's important for a couple of reasons. It's important because just human nature is such that you tend to pay attention more if your own money is in things, right? And number two, it's just sort of commonsensically, if you're encouraging someone to put their money in something, and you're not willing to put any of your own money in it, well, that's kind of counterintuitive, right? If this is such a great deal, why aren't you willing to put any money in it at all, right? So generally, I mentioned this tower in Mexico, so that's a deal where I don't know, at least the first $1 million that goes into that deal is going to be my own money, right? Because I believe in the deal. I wouldn't be doing it otherwise. There's most sophisticated investors. That's one of the questions they will ask. Is, do you have any of your own money in the deal?
Cindy is asking a really, really good question. Sure. How do you find good investment opportunities?
Yeah, well, that's the $1 million question, right?
Yep.
There are some people that say, find good managing members. That's how you find them, right? You find people who are good at what they do. But if you're out there trying to find deals yourself, then what I tend to recommend is that you decide on a particular strategy. So let's say you locked into an ADU strategy, and you become laser beam focused on that. Everybody who's touching that space, all the real estate agents, the people at the planning department, and because the way that deal is going to bubble to the surface is that you're going to be talking to someone who is talking to someone who knows you're looking for a deal, right? So you need to let everybody know that I'm looking for this kind of deal, because right now we're in a very competitive environment. Everybody is starting to figure out, hey, significant wealth gets generated through real estate. Maybe I should take a hard look at this, right? And so in order to stand out, you have to be more focused and more consistent in your efforts than other people that you're competing with.
Okay, so the purpose, we're getting some questions here about how they can invest with you. Let me be clear. This wasn't really the purpose of the but let's answer the question straight on. We had asked Kwame to come in and talk about what to look for in good investments. But if they wanted to invest with you, what's your criteria?
Well, it's the minimum investment is $100,000. Typically in my deals, some cases it's more, but most cases not. And really, it's about a conversation, right? It's about making sure that here's what I do. What is this person interested in accomplishing? Do they want big chunks of money? They want monthly money? Do they want retirement money? Right? And really making sure that there's an alignment. So normally I would have that kind of conversation with the person. They get to know who I am and some of the things I'm doing. And I think that maybe Don Kendall said that he was going to, if people needed a way to reach me, he was going to circulate something that allowed people to be able to reach out and talk to me and just kind of find out more. So I don't know how Kendall is circulating that, but I think that would be the best way for them to do it.
Okay, so it looks like he just put it in the chat screen.
Okay.
How to contact Kwame, click protectwealth.com / what is it, Kendall? Build Wealth?
Build Wealth. Yeah. So just click that link. It's in your chat screen, protectwealth.com / build wealth. And Kwame, you obviously mentioned there are some pre-qualifications, things like that. If you're not ready to invest, things like that, whatever you think there, Kwame.
Yeah. And look, just because someone might not hit my threshold doesn't mean I'm not perfectly happy to talk to them anyway, and just, steer them to maybe someone that can help them. Because there are a lot of different ways to come at this industry, and there's no necessarily right way, and there's no there's a lot of different ways that are equally powerful depending on what you want to achieve, right? The important thing is to recognize that it is, in my opinion, one of the single most powerful ways to ensure that you achieve financial security.
Okay, good. So Blanca is saying, how do you find out if an investor really has experience? How do you do your due diligence on somebody that's claiming that they've got a great deal? What type of due diligence are you looking at? How do they, you mentioned check and the local bar association, see if they really are an attorney, but that doesn't really say if their investments are working.
Yeah, absolutely. So as I understand the question, it's you're the person with the money and you're trying to figure out how do I know this person I'm talking to really is doing what they say they're doing, and they're right. The answer to that is ask for a lot of proof. And what I mean by that is, so if they're claiming that they have a cash flowing investment, ask them for P&L statements, ask them for rent rolls, ask them for tax returns, ask them for, the phone number of their property manager, so you can call that person and talk to them about the building. Stop by the building and just talk to some, residents. I promise you that residents are more than happy to give you an earful if there's a problem with that asset, right? If you go to an apartment building and that apartment building is being managed poorly and has major issues, they're going to give you an earful. And by the way, it might still be a profitable investment, but you want to know if that resident's story lines up with the sizzle that this person gave you during their presentation, because they might have disclosed to you that, oh, it has a problem with the water line, but it's still profitable, right? You want to just kind of verify their story, right? If they're saying they flipped a house last week and they made X amount on it, great. Show me the closing statement, the settlement statement. That's what I used to give my investors in my flips when I first started. I would give them the last 3 closing statements of deals that I just flipped. Here's what I just flipped. And by the way, here's the settlement statement from when I bought it. So you can see, here's what I bought it for, here's what I sold it for, right? No mystery. So in short, make the person verify the story. Don't just settle for the sizzle.
And it's not about, they come back and say, don't you trust me? Has nothing to do with that.
No, in fact, if somebody says that, that's the end of the meeting. That's they shouldn't even respond like that, because it's absolutely reasonable for you to. I've had people do due diligence on me for months. They want to speak to my employees. They want to all kinds of things. I have zero issue with any of it, because you're talking about a significant decision that someone's trying to make.
Good. Pierre, how do you build a great team? How did you build the great team you operate with?
By treating people well. And I know that seems like a sort of vague, fuzzy answer, but I don't. It's the best way I can explain it, because let's say if you have a contractor that you meet a contractor at Home Depot and you say, or at Lowe's, and you say, I really want you to start working on my project with me. And you treat that contractor, you pay the person on time, you pay them in full, you don't play games with what you're paying them, then that person ends up talking to, an architect. And they said, man, this person's a great person to work with. They shoot straight, they tell you they do what they say they're going to do. And now all of a sudden you've got an architect who wants to be part of your team, right? And so that's how I built. If I were to introduce you to my staff, there are a lot of people in my organization that have worked for me their entire professional career. Like they've never worked anywhere else, or they've worked for me for the last going on 20 years, right? Or over 15 years for sure. And it's because I try to treat people well, and that's the best way, in my opinion, to build an organization.
Thank you. Tiffany, if you discussed investment erosion, what type of research should you leverage to find areas around the country that might meet your investment criteria if you're just starting out? How do you find up and coming markets?
Yeah, well, supply and demand is always going to create opportunities, right? So anywhere, it's relatively easy to figure out what cities have the fastest population growth, and it's relatively easy to figure out what the housing stock looks like compared to that population growth. So, for example, there's a measure that most cities use called housing starts. So it's how many permits were applied for, because normally there's a lag time between when you apply for the permit and when you can start building. And so so the number of permits in the queue will tell you how well that city is going to meet its growing demand. And if the housing starts are lagging way behind the population growth, they've got a shortage. And so if you see that, and normally my next step is I call an agent and I say, hey, looks like you have a shortage. Do you have a shortage? And the agent will say, well, as it turns out, we can't keep a house on the market. The minute it goes up for sale, it's gone because we have such a shortage, right? So it's that process of finding disequilibrium investing is a little trickier, right? You have to have a little bit more experience in recognizing when something is creating this kind of out of whackness that can create these larger than normal returns, right? So that takes a little bit more experience to do that, but it's easier to find just supply demand disconnects.
Is reading, let's say, city council meetings, do you do that? How do you do market research?
Yeah, so city council meetings will tend to help you if you are trying to, it can help with heat path kind of investing. So I'm trying to figure out, where the heat in this area is moving towards, right? If the city council says we're going to build this, and this in these areas, you kind of know that's where the energy is going. I tend to look at a lot of stuff like that. I look at a lot of what the cities, like, for example, I just finished reading Los Angeles City's 5-year plan. So I can figure out what are the powers that be in Los Angeles, what are they trying to do over the course of the next 5 years? Because that tells me where the city is going, right? What kinds of industries they plan to support, what kind of buildings they want built to support those industries. So I read a lot of that. I would consider that kind of real estate 201 as opposed to real estate 101, because you have to have enough experience to know how to interpret that information. Because otherwise, let me just make this one last point, Don, because it's kind of important. Because otherwise, what can happen is you can get in too early. So in other words, you're looking at a path that's really a 10-year play, and you buy now, not realizing that it's going to take 10 years for the path to catch up to you. Okay, so that's why I say it requires a little bit more experience in terms of understanding what you're reading in those city council reports.
Good. Mark is saying, how do I get a copy of the 10 qualifying questions? And anyone who registered for this webinar will get a recording of this tomorrow. Watch your emails from us. And I think that's, is there a better answer than that, Mark, than just watch the thing again and take good notes?
I think that's the best one, Don. I'll make sure that's out tomorrow. Anybody who's on the registration list. So as long as you're registered, that'll go out. Sometimes we generally leave most of them up for 30 days, sometimes more, depending on what we have on our channel right now.
Kwame, I don't know of a site where you, or a place where you list the 10 qualifying questions. I wrote them down. But,
well, yeah, I know. At some point here, I'd like to be able to, as we do more of these, Don, I'll make sure to start having some of this material kind of pre-packaged so you can kind of shoot it out to people. But yeah, I guess for now, I would say just re-listen to that section and also listen to what I'm saying to listen for in the answers. So don't just write down the question, but also listen to what I'm saying you should be, as the person is answering the question, what are you listening for in the answer?
Okay, good. Susanna, what if I have $100,000 to invest, but don't match the other qualifications to be part of a fund? And do all of your investors have to be accredited investors?
Not always. So it's if it's not a fund, then no. So right. So if someone has the minimum threshold, let's say $100,000, but they're not accredited, that's perfectly fine if it's not a fund. So sometimes, I'll do a deal where it's just that house, and the house is, we're going to do an ADU, and it requires $200,000, and that's it. It's just me and that person. In that case, the person doesn't have to be accredited because it's not a fund. But if it's a fund with a lot of other investors and subscription agreements and Reg D offerings and all that stuff, then yes, the person needs to be accredited.
Brandon is saying, thank you for sharing helpful information. Very interested in ADU housing in the Florida market. I have existing real estate properties, rental properties, but that lots have space for me to build in them. I'm still learning about the niche. Well, thank you. Tammy's saying, great presentation, lots of actionable information. Dorothy saying, what if it's a large fund, say Realty Mogul? Can we still ask for verification and track records?
Absolutely. In fact, the bigger the fund, the more proof you want, because the more difficult it is to talk to real people. Good.
Do you see another housing market crash like 2008 due to COVID allowing investors to secure properties at a low rate?
Yeah, so that's a really good question, actually. And Don, at some point, maybe what we can do is another webinar where I have a tool that I call the Granderson Composite Index, where it measures a lot of factors that go into kind of housing market crashes. And the short answer is that a lot of the indicators right now are pointing to some sort of significant pullback of the market. Now, the 2008 crash was a generational level crash. I don't know that that's going to be repeated anytime soon, but there is definitely a lot of indication that the speed at which property is accelerated and appreciated over the last year and a half to 2 years, driven primarily by artificially low interest rates, that will slow down / potentially pull back. Yes.
And I see one major difference in that we're not overbuilt right now. There tends to be a shortage of housing
exactly
in almost every market.
Exactly, Don, and that's the qualifier. So if you were looking at the Granderson Composite Index, you would see that housing starts number, it is not like 2008 where there was this massive oversupply of housing at the same time that the plug got pulled out of the wall with the mortgage-backed securities and everything that went into that crash, negatively amortizing loans, all of that stuff. A lot of that stuff is, the banks are healthier now than they were then. There's less housing supply than there was then. There's a lot of things that are different about this market.
Okay. So we're getting more questions about what's that link again? I think it was protectwealth.com/build wealth. And on that, Ken will maybe help me out with that, but I think it's simply put in your information, and Kwame, what is it that he'll get back with you or somebody from his team?
Yes, Kwame, maybe you're someone from your team. I really put in name, email, phone number, and that's kind of where we'll leave it. And, Kwame, I know your team will do your best. It's probably not going to be instant.
Yeah, right? Well, if somebody leaves their information, we will definitely get back to them. And, whether it takes a couple of days or, I would just say be patient. over the next few days, early next week maybe, but we will definitely get back to anybody that wants us to reach out to them. And by us, I mean, it will either be me personally or it will be someone who reports directly to me.
Okay. Somebody's asking, will I have to file taxes in different states if they invest with you?
It's possible. I don't tend to like to give out tax advice. I generally leave that to people's tax preparers, but I have seen people have to do that, and it's generally not problematic. It's not difficult. You get more than one K1 depending on the state, and it's not difficult.
Yeah. Okay. Great presentation. Thank you. Thank you. Would you think of becoming a sponsor to anyone who's willing to work on multifamily investing and wants to do well for their investors?
I'm not sure what the person means by sponsor. I'm not sure what they mean by
becoming a sponsor. Yeah, Iris, maybe you can qualify that just a little bit. Great, a lot of thank yous. We appreciate that. I'd like to learn more about investing in mega projects, but I'm not an accredited investor. Okay, so a lot of good comments, a lot of good thank yous. I would say, Iris, maybe this would be a question. Fill in your information and contact them, and they'll get back to you, and maybe they can talk about your personal situation.
Yeah, absolutely. And by the way, everybody who's on tonight, the expectation is that there will be more of these. So there will be a lot more information that we're hoping to share over time. And so this is, I'd like people to think of their path in real estate and building wealth as an ongoing learning process. It is not a sort of a thing where you expect to or should expect to get all the information all at once. It's you evolve and you grow and you become better and better at this as time goes on. You know, and so it's a path that you have to commit to over time.
Yeah, and our goal for teaching this was to give really good information so that you can go out and look at any investment, not necessarily throw fish at you, but to teach you how to fish. I think that was really kind of the goal. Yeah,
just, so here's kind of basically what the structure looks like, and here's some questions to ask, and and if you take those 10 questions seriously and demand good, solid answers to those 10 questions, you're going to get a lot of the information that you need to make an informed decision.
Good. Damien's asking a really good question. Do you have any apprentice opportunities available? Damien, wouldn't you love to sit at his feet and work with him for a few months and just learn to think like he's thought? But you also taught a really good webinar for us back in June. Kwame, just thinking the thought process you've gone through. Oh my gosh. Listen to that. Incredible information.
Well, here's what I would say to that. I as you might imagine, I get that question a lot. And so and Don, you know me well enough to know that if I get a question enough, I think seriously about how to address it. So I'm going to try to create something that and the name that was on the screen, the Granderson Financial Literacy Academy, is going to be is kind of heading in that direction. I'm going to try to create something that allows people to sort of to kind of learn as an apprentice, and go through this process of absorbing a lot of this information over time. And I'm in the process of creating something like that. It'll probably be out next year sometime, maybe first quarter, second quarter of next year. But I definitely take the request seriously. I really do understand that there's people want good information from people that they feel comfortable with.
Great. Kwame, we're getting lots of little thumbs up and appreciations and I can't thank you enough for your time and we watch watch our webinar series and attend our 3-day summits. I guarantee Kwame will be back and will be a featured speaker for us. But if you'd like a little bit of one-on-one time, sign up for that, protectwealth.com/build wealth, or click on the link in your chat screen. It's probably easier than going to that. Any closing remarks, Kwame? What would you leave them with?
I would just say that your instincts are better than you think. And as you go out there, whether you're going out there as a manager, you're going out there as an investor, really, get past the sizzle, listen to people carefully in terms of what they're saying, and go out there to do right by people and to have people do right by you by holding them accountable.
Such good information. Thank you, my friend. We appreciate you being on. For those of you who have individual questions, our time is up, but go ahead and click on that link and they can get back with you that way. Kwame, thank you for your time. We so appreciate it. All right.
All right.
You take care.
Thanks, Kwame.
Bye-bye.